the thing is that uh,
क्या मतलब मैं समझा नहीं.
mm, okay. So, yeah. So we were talking about these multiple risks which are there during your international financing. So we have like risks like interest rate risk, political risk. So we need to have certain mitigation, your mitigation methods which we should follow to avoid these risks. Fine. Then we have cost of capital. So cost of capital, now it totally depends what sort of instrument you are raising for instruments through which you are raising international funding. Okay, so cost of capital, I think that's a new thing for you. Let's explain, understand what is first of all cost of capital. So, cost of capital, it is a kind of a, you can say, it represents the minimum return a company must earn to justify investments and financing decisions. That's the cost of capital, that minimum return which company has to earn. Okay, so in international financing, the cost of capital is exchanged by exchange rate risks, you can say interest rate variations. Then there are political conditions and taxation policies which are there across countries. Okay, so we have cost of equity, which is basically the cost which this equity shareholders they want. Okay, that minimum return on the cost of equity. So the return required by equity investors for providing funds, that is your cost of equity. Then the cost of debt. So the debt holders they basically need the interest. Okay, so the return required by lenders for providing debt capital. That is your cost of debt. So your cost of capital is going to be a summation or combination of your cost of equity and cost of debt. Now, what impacts cost of capital in international financing? I think cost of capital is clear that it is a combination of cost of debt plus cost of equity. Okay, so now what impacts this cost of capital? So first can be, since it is an international financing, the biggest reason is going to be your currency fluctuations, exchange rate. Wait a second. Okay, so it is going to be your currency fluctuations which impact debt and investor returns. Okay, so currency fluctuations it impacted repayments and investor returns. So if the Indian rupee depreciates against the USD. So Indian firms they issuing dollar denominated bonds they face higher repayment cost. Okay, so there is a huge exchange rate risk. Then to basically to avoid this, you can have your currency hedging techniques like forwards, options, swaps. Okay, so we can basically take those instruments to avoid the that your this exchange rate risk. Okay, then we have interest rate differences. So different countries they have different interest rates and it impacts your borrowing cost. So we have risk mitigation like diversify debt sources and optimize currency selection for borrowing. Okay, then we have country risk. So unstable economies, they have higher capital costs due to risk premiums. Okay, so we have like unstable political situations in that country that can lead to huge country risk. Okay, then we have tax policies and you can say DTAA agreement. They can also impact your cost of capital. Fine. Then certain like the fifth point, strategic objectives. Like what are the objectives of that country? So that can be, you can say that is also a big factor in influencing your financing decisions. Like if you are, if the strategic objective of international financing, it involves around, optimizing the cost of capital, risk management, financial flexibility, and global competitiveness. So, all of this impacts your international financing decisions, then your investor preferences. Now, if the investor is very you can say hesitant, or very they play safe, so they will not be investing in the riskier instruments. Okay, on the contrary, if the investor is very, they are keen to invest in, and they're willing to take risk, then there will be enough of international working capital. Okay, so investor preferences, it definitely impact the financing choices. Then exchange rate considerations. So exchange rate considerations basically say that if the exchange rate is very fluctuating, then the investors will be they will be very averse in taking the international funding. So yes, it impacts significantly the decisions of funding. So cost of borrowing, your foreign investments, revenue repatriation, financial risk management. So all of this, your transaction risk, translation risk, all of this impact your international financing decisions. So I think we have discussed in detail all the points. If you want to understand all of the points again in detailed way, we have covered all of this in our study material also. You can go through that as well. Okay. Apart from that, I think we have covered all these points. Now, what are the issues in overfunding choices? So definitely, when we are basically when we are issuing funds in the international market, there are a lot of issues. So issues basically, they you can say that overseeing funding, it refers to the process of obtaining capital or financial resources from external sources located in foreign countries or jurisdiction. So multinational corporations, they have several options for sourcing funds internationally, including FDI, international capital market, multilateral institutions, foreign banks, and financial institutions. Okay, so FDI, basically FDI is like your foreign direct investment. Okay, so FDI is when your foreign countries, they invest in another country. Okay, so FDI is also impacted by your funding choices. So you can say that, first of all, let's understand FDI, that it is a kind of a you can say long term investment by a foreign entity in a business located in another country. So it involves, you can say, ownership, control, and active management of foreign business operations, distinguishing it from portfolio investment like stocks and bonds. Okay, so there are various types of FDI, like we have greenfield investment, uh, we have brownfield investment. So all of this, I think we have done in one of our previous sessions also, where we were discussing your FDI. Okay, so this FDI basically it definitely impacts your funding choices, that what should be taken, like how your this particular FDI should be used for funding reasons, because there are certain political and regulatory risks also. For example, in India, there is a FDI restriction in e-commerce, which definitely impacted companies like Amazon and Flipkart. Okay, then we have foreign exchange and repatriation issues, like certain countries, they limit foreign firms from repatriating profits. Okay, then there are certain cultural and operational differences also. Like McDonald's, it has struggled initially in India due to local food preferences and operational issues. Okay, so and yes, definitely FDI regulations, like every government, it has its own set of this FDI regulation. Okay, like there are certain government incentives, sometimes tax benefits, then there are certain sector specific regulations which are there. Okay, so there are various types of, you can say, regulations which are there in the market to impact your decisions. Okay, so we can say that FDI, it plays a crucial role in global business expansion, economic growth, technology transfer. Then companies must evaluate market conditions and regulatory policies and financial risks before investing in foreign markets. Okay, so that is your thing. So that is about FDI. Now the next is your international International capital market. So I think international capital market, the last session we have discussed it in detail, that what is basically the international capital market, and what are the choices which are available in the international capital market, what are the risks in that. So international capital market, it is primarily, or you can say, uh, a market, which where we are trading into stocks, bonds, derivatives, loans from all the different countries. So it basically allows companies, governments, and investors to raise capital globally, and it provides a platform for international investments. Okay, so that is our international capital market. Now, part of it is the international equity market, where we raise funds by issuing shares in foreign stock markets. So that can be done through various ways, like ADR, GDR, like what we have discussed today also, cross-border listing of stocks, then your foreign investor participants, and these are various ways through which we can raise funds. Then we have international bond market. So international bond market, basically companies and governments, they issue bonds to raise long-term capital from foreign investors. Okay. So for example, like Apple issued bonds in European market to take advantage of lower interest rates over there. So they issued bonds in the European market. Okay. Now there are various types of bonds also. So totally, like we have foreign bonds, we have euro bonds, we have government bonds. So it totally depends upon the nature of the company and their requirement through which they want to raise the funds. Okay. Then we have the next point is your uh, next point is the multilateral institutions. Now, multilateral institutions, they basically they have multiple, you can say multiple types of instruments which they have used for raising funds. So, multilateral instruments, they're, you can say, a kind of an agreement or tool which involves multiple countries and institutions to facilitate your trade, investment, and financial stability in the global economy. So you can say primarily it helps in managing your cross-border financial transactions, your risk mitigation, and economic cooperation among nations. Okay, so we have multilateral development bonds. So these are financial institutions established by multiple countries to provide financial and technical assistance to developing nations. So for example, we have World Bank, which provides long-term development loans. Okay, then we have International Monetary Fund, which offers, you can say, short-term assistance and economic stability programs. Then we have Asian Development Bank. So funds infrastructure projects in Asia. Then we have European Investment Bank. So it finances projects within the EU and beyond. Okay, so we have multiple development banks, like so the purpose is basically to provide low interest loan and grants, and to support infrastructure, education, and healthcare projects. So yes, it stabilizes economies in the financial distress. Then there are certain set of international financial agreements. So there are agreements between multiple nations to promote, you can say, financial cooperation, investment, and trade. Okay, so we have those agreements basically to promote financial stability, to encourage economic cooperation, and to reduce the financial risk and crisis. Okay, so these are basically the purposes why we have these multiple international multilateral institutions. Now the last one is your foreign banks and financial institutions. So foreign banks and financial institutions, they basically uh, provide, you can say, first of all, foreign banks, they operate in a country different from the home country. That is a foreign bank. These banks, they facilitate international trade, foreign investments, and global financial transactions, and they play a significant role in integrating, you can say, domestic markets with the global financial system. Okay, so that is your foreign banks roles. And yes, for example, if you see in India, we have Standard Chartered Bank. So that bank is controlled by the central bank of the host country, not by us. Though it is operating in our India, but it is an extension of the parent bank, which is situated in another country. Okay, then we have subsidiary banks. So subsidiary banks, like a foreign bank establishes a, you can say separate, just a second. So foreign, a subsidiary bank. We were talking about subsidiary banks. So a foreign bank which establishes a separately incorporated entity in the host country. So it functions as an independent legal entity, but it is owned by the parent bank. So that gives more flexibility in local banking operations. So if in India you can compare it with like HSBC Bank, which is a subsidiary of HSBC Holdings UK. Okay, so that is a subsidiary bank. Fine. So these are basically the you can say overseas funding things. Now there are certain advantages of overseas funding. So basically, first of all, you get an access to large set of investors. Okay. So since we get access to large set of investors, so we have a lot of options. Okay, if you confine yourself to one country, then obviously the resources are limited. Okay, so overseas funding, when we are doing overseas funding, there are a lot of advantages, like it can be lower cost of capital. So companies, they can access funds at lower interest rates compared to domestic sources. Then many developed countries, they have lower interest rates than emerging markets. Then investors in global markets, they may demand a lower risk premium. So, for example, an Indian company, it can raise funds through foreign bonds, and it may pay lower interest and borrowings from Indian banks. Okay. Then we have access to larger capital markets. Like companies, they can gain access to global investors and larger pools of capital. Okay. So we can expand funding options beyond domestic banks and stock markets. So more liquidity available in international financial centers like New York, London, Hong Kong. Okay, so we have we get an access to larger capital market. Then we diversify a lot of funding sources, like reduces dependency on a single market and spreads financial risks. So companies can raise capital from multiple countries, and it protects against economic downturns in the domestic market. So, a multinational company, it can issue bonds in Europe, raise equity in the US, and get bank loan in Asia. Okay, so they are multinational company which can issue bonds in Europe and raise equity in the US. Okay, then we have favorable exchange rate movements. So, like borrowing is a foreign currency with a stronger home currency. It can definitely lead to cost savings, and if the local currency appreciates, the repayment cost in foreign currency reduces. Okay. And it enables companies to take advantage of currency arbitrage opportunities. So, for example, if an Indian company, it borrows in USD at 4%, while domestic loans it costs 8%. So it benefits from the lower interest rate. Okay, so that is again a big benefit of your overseas funding. Then, like we have discussed, like you get an access to more and more types of financial instruments. So international market, it offers innovative financial products not available domestically. Okay, so companies issue euro bonds. Just a second. Okay, so we were discussing advantages to better financial instruments. So international markets, it offers innovative financial products not available domestically. So companies, they can issue some euro bonds, global depository receipts, your American depository receipts, and foreign currency convertible bonds. Okay, so they have access to better financial instruments. So, for example, Reliance Industries, they issued VDRs in London to attract global investors. Okay, then we have improved corporate reputation and global expansion. Okay, so raising funds internationally enhances brand visibility and credibility. So it attracts international investors, partners, and customers. So it definitely strengthens the company's global presence, facilitating market entry into foreign economies. Okay, so international funding, it gives a lot of advantages to the company because you get a recognition internationally if you are listed on foreign stock exchanges. So not even in your country, but from in other countries, you can get a huge reputation. Okay, so raising funds internationally, it gives you a lot of brand visibility and credibility. Fine. Then we have, like in case of your international funding, you have longer repayment periods and flexible terms. Like international financial institutions, they give longer repayment periods than your domestic lenders. So global lenders, it provides structured loans with some sort of grace period also. Then it enables businesses to spread repayment over extended durations. So these are longer repayment periods and your flexible terms. Fine. Then let's move to the disadvantages. So disadvantages, and you can say you can manage the advantages and disadvantages together. So you have currency risk, you have regulatory complexity, political and country risk. Okay. So exchange rate risk is there. So if the domestic country depreciates the cost of repaying, so foreign debt increases. Then there are fluctuations in exchange rates which can make loan repayments expensive. So companies, they need hedging strategies like currency swaps, which add costs. So for example, an Indian company, it borrows in USD at 80 rupees per dollar per USD. Okay. So if the rupee depreciates to 85 rupees per USD, the repayments will become more expensive. So that is a kind of a disadvantage, that you have to pay more because of the changes in exchange rate. Then the compliances are very high. We face a lot of higher compliances and regulatory burdens. So companies must comply with foreign exchange laws, your tax regulations, reporting requirements in multiple countries. So we have complex documentations, legal approvals which are required, restrictions on repatriation of profits which may apply. So you have higher compliances and regulatory burden also. Then a lot of political and economic risks are also involved, political instability or economic downturns in the host country, which can impact funding terms. So governments, they may impose capital controls, restricting fund movement, changes in tax laws, which can increase cost for foreign funded business. Okay, so you have political and economic risks. Then interest rate fluctuations are there, like global interest rates, they may rise, making external borrowing more expensive. So companies borrowing in float rate investment instruments, they are at a higher risk of rising debt cost, because float rate, it keeps on changing with the changing rate. Okay, so uh, central bank policies in countries like, you can say, USA, it can impact your loan rates globally. So we have interest rate fluctuation. Then risk of over leveraging and debt dependence. So easy access to foreign funds, it may encourage excessive borrowing, increasing debt levels. Then companies may struggle to generate enough revenue to meet foreign debt obligations. Fine. Then over reliance on foreign loans, it can make a company very vulnerable to certain external economic shocks, because when everything is international now, for just imagine a scenario where there's a political turmoil in 5 countries. Now, because your investment is majorly into international market, now your economic situation will be deteriorated because of that negative situations in other country. So over reliance on foreign loans, it can make a company very, very prone to external economic shocks. Okay. So for example, in Sri Lanka, it was a high foreign debt laden company. They have taken a lot of foreign debt from other countries, and in 2002, it failed to repay international loans and their economy crashed. Okay. So That was about a lot of disadvantages in your overseas fundings. So yes, while we can say, like, to conclude, we can basically say that overseas funding, it, yes, it provides access to cheaper capital, global markets, diversification benefits. So businesses must be very careful. They should assess it very properly. All the risks related to exchange rates, regulations, debt burden, foreign investor influence. So, a balanced funding approach is very, very essential to maximize benefits while mitigating the risks associated with foreign funding. Okay, so advantages and disadvantages are done. Now, what are the factors influencing overseas funding? Like, when evaluating, multinational corporations need to consider various factors, and I think we have already discussed this: interest rates, currency risks, and regulations. We have discussed this in the first slide itself. Okay, so several key economic factors which impact funding decisions. We have interest rate, inflation rate, growth prospects, and exchange rates. I think interest rate is discussed. Inflation rates. Now, this is important, that inflation rate, yes, it definitely impacts your international funding. Now, what first of all, what is inflation? Inflation, it is the rate at which the general price level of goods and services rises, leading to a decrease in purchasing power. So it is measured by indices such as consumer price index, wholesale price index. Okay, so what happens is, how this inflation rates affect international financing. So cost of borrowing. So higher inflation, it leads to higher interest rates, making the borrowing more expensive. Okay, so what happens is these central banks, they raise the interest rates to control inflation. The foreign loans, they become costly when inflation rises in the borrowing country. So for example, if in India inflation rate rises from 5% to 8%, the RBI may increase interest rates, making foreign loans more expensive. So that is your cost of borrowing. And then we have exchange rate fluctuations. Like countries with high inflation, they often experience currency depreciation. So foreign investors, they demand high returns to offset the inflation risks. So depreciation, it increases the cost of repaying foreign debt in foreign currencies. Okay, so that is your exchange rate of fluctuation. So that basically your impacts this inflation rates. It definitely impacts your foreign funding. Okay, so these you have to be we have, like, inflation, it directly impacts the international financing decisions through impacting your borrowing cost, your exchange rates, your FDI inflows, and investment stability. So all the companies and governments, they should adopt some strategic financial planning and risk management to, you can say, to face these inflation related challenges. Okay, so we should have certain, we should take certain measures like hedging, borrowing in low inflation economies, diversifying your investments to somehow mitigate the risks from inflation volatility, then monitoring central bank policies to anticipate interest rate challenges. Okay, so this is done. Now we have to start with role of macroeconomic indicators, and then we'll be doing this capital budgeting. So what we can do is we can take a break for 5 minutes, and after that we will continue with our discussion. Okay, so let's continue with our discussion. Uh, like we were on this part, factors influencing overseas funding choices, and this several key economic factors. Now, the next thing which we need to discuss is your role of macroeconomic indicators. Okay, so macroeconomic indicators basically they are, if you talk about micro and macroeconomics. Okay, so microeconomics is basically when we are looking at the smaller things in the economy, like a particular household, one individual. Okay, now opposite, when we see at the bigger issues like statistics related to the nation, that are macroeconomic indicators. So macroeconomic indicators, they are, you can say, key statistics that reflect a country's economic performance and health. They influence foreign investment, exchange rates, international financing decisions, and corporate strategies. So these are basically your economic indicator, basically your macroeconomic indicators. Now, how they impact our international financing. Now, the first one is your GDP, gross domestic product. So the growth rate of GDP, that will also impact your this macroeconomics, sorry, the international funding. So GDP, first of all, what is GDP? GDP measures the total value of goods and services which are produced within a country. Okay, so that is your GDP. Now, GDP impacts, yes, GDP growth rate, it impacts your international funding also. So GDP measures the total value of goods and services produced within a country. High GDP growth, it attracts foreign investment and international loans. Slow GDP, it grows, it signals economic instability, making foreign lenders very cautious. Okay, so for example, India's GDP growth was some 7% in 2023, and similar to that was in 2024 also. So it attracted global investors. Okay, so while there was a recession in UK, it discouraged international financing. Okay, so the thing is like this GDP's growth rate, it impacts the global financing also, similar to inflation rate also. Like inflation rate, it is basically the rise in general price level, which I've explained you. That inflation measures the rise in general price levels over a particular period of time. Now, high inflation, it reduces the purchasing power and it increases the borrowing cost. Fine. Now, foreign investors, they avoid high inflation economies due to uncertainty. Fine. So, for example, in Turkey, there was a very high inflation which was over 40%. So, it led to capital outflow. While low inflation economies like Switzerland, it attracted stable investments. Okay, so inflation rate, it impacts international funding because of your high inflation and low inflation economies. Fine. Then interest rate, or you can say monetary policy of any country. So in every country there is a central bank, one central bank, like in India we have RBI, in US we have Federal Reserve. So these central banks, they set interest rates to control inflation and economic stability. Fine. So high interest rates, it increase the cost of foreign borrowing, and low interest rates, it encourages companies to raise funds internationally. Okay, so the US, for example, you can say the US Federal Reserve, it rates were increased very high in 2024. It made the US borrowing in USD very costlier or very expensive for other nations. So that impacted the global financing strategies. Fine. Then there was this exchange rate stability. So the exchange rate is, first of all, it is the value of a country's currency against another. So currency depreciation, it increases repayment costs for foreign loans. So a stable exchange rate, it reduces foreign risks, attracting global investors. Okay, so for example, the Indian rupee depreciating from, you can say, 74 to 83 per USD, it increased the repayment burden for companies with USD loans. Fine. Then there were certain foreign exchange reserves also. So foreign exchange reserves like your forex reserves, it include foreign, first of all, it includes your gold, currencies, as special drawing rights. So higher reserves, it boosts the investor confidence and it ensured foreign debt repayment. Okay. Low reserve, it increases the currency risks and deter the foreign investments. So the point is that foreign exchange reserves, be it foreign exchange reserves, exchange rates, all of them, they impact the you can say your these macro indicators, basically macroeconomic indicators, impact the funding. Now unemployment rate, so unemployment rate, yes, a very, because unemployment rate is measured on an overall basis, it is a like it is seen for the entire economy. Okay, so unemployment rate kind of impacts the you can say the international financing, because it has a direct impact on FDI. High unemployment may you can say deter the FDI if it signals economic weakness. Now, for example, if any country has a very high unemployment rate, fine. Now the country who is planning to invest in that particular country, that in foreign country, so they will see that okay, there is a so much in unemployment. That means it signals that the economy is very weak. So they will not be willing to put this FDI into that country. So high unemployment rate may signal economic weakness that will eventually lead to reduce the FDI percentage. Okay, so foreign investors, they usually prefer economies with a skilled and employed workforce. Then persistent high unemployment, they definitely indicate a lack of business opportunities. So countries with low employment unemployment like Germany, they attract more FDI than economies with high unemployment like South Africa. So it may impact on interest rates and monetary policy. So high unemployment, it lead to lower interest rates to stimulate economic growth. So for example, central bank, they cut interest rates to encourage borrowings and job creation. Then lower interest rates, they make foreign loans cheaper for businesses. Fine. Then it definitely has an impact on your consumer demand also, because if there is unemployment, then there is reduced, purchasing power, reduced consumer spending. So it will slow down the economic growth. So that is why countries will not be willing to put that enough funding into a country where there is huge unemployment. Fine. Then the next is your interest rates. So if the interest rates in any country are very high, so other countries will be, you can say, willing to invest because they will be getting a higher return. Okay. So interest rates, like you can say high interest rates, they make international loans expensive. You cannot borrow from that economy which is having higher interest rate, because you will have to pay additional financial burden. Okay, so higher interest rates, it makes international loans very expensive, and companies and governments with foreign debt, they face higher repayment cost. Okay, so that is your cost interest rates. Then consumer confidence. Now, if consumer in any country, they have confidence, they have faith in the government of that country, then in that case, foreign investment will be very very welcomed in that nation. But if the country is not having enough trust on the government, then these foreign investments will not be very fruitful in that particular country. So these are basically your few of the macroeconomic indicators and their impact on the foreign funding. Okay. Now funding and risk management aspects. So funding and risk management aspects, they basically cover that your this you can say, there are, first of all, there are a lot of risks. We have discussed, we have currency risk, we have your interest rate risk, we have political risk. So all of these risks, they are need to be tackled by every country in their own way. So how they will be tackled? They will be tackled by using certain appropriate hedging strategies,
like use of certain forward contracts, options, swaps, and natural hedging. Okay, so we have optimal capital structural, we should follow this optimal capital structure, which will be helpful in managing the debt and equity. Fine. So risk management strategies, they're very crucial for multinational corporations to identify and assess and mitigate various risks that may affect their financial operations and performance. So some common risk management strategies, it include your diversification. Diversification basically means you need to spread your investment through multiple options. Okay, diversification will reduce your you have to diversify your funding resources like equity, debt, bonds, and multilateral financing. Then you have to use certain hedging strategies to minimize the currency and interest rate risks. Okay, you have to use hedging strategies. Then you have to monitor your global economic trends like inflation, central bank policies, building strong financial reserves to manage liquidity crisis. So there are a lot of things which should be done. So risk management strategies are crucial for multinational corporations. Okay, and then insurance and scenario analysis, like the company has to take appropriate insurances also to cover up all the risks, fine, which are arising due to international funding. Then scenario analysis is primarily case based analysis, like if the US market is not doing very well and you've invested a lot of funds into the US market, then you have to you have to research that entire scenario. You have to see what are the pros and cons of investing in US market, and then you have to carve out your you can say risk mitigation strategy. So that is scenario analysis. Okay, I think this part we have completed earlier. Okay, now okay, now mitigation technique. Mitigation, first of all, mitigation techniques, basically, mitigation is like, you can say managing the risk. So, managing the risk is like you have to decide on the, first of all, you have to decide on the basis of your what sort of funds you have borrowed, what type of funding you have taken from other country. So, multinational companies, they employ various mitigation techniques to manage risk effectively and protect against adverse outcomes. So some common mitigation techniques, they include risk identification and assessment, then risk avoidance, then risk transfer, and risk monitoring and review. So you can say that risk mitigation, like international financing, it kind of exposes the entire economy to multiple risks, such as currency fluctuations, some interest rate volatility, political instability, and credit defaults also. So there are various ways which you can employ to mitigate those risks. Like we have hedging, we have derivatives, we have swaps, we have options. You can have diversification of funding sources also. We have political risk insurance and regulatory compliances also, which you need to follow. Then we have this strong liquidity and credit risk management also. Okay, so to cover up, first of all, to cover up this foreign exchange risk, okay, you have to get this risk identification and assessment done. Okay, then you have to take you have to basically, first of all, you have to identify what sort of risk is there. Then you have to assess what is the quantum of that risk. Fine. Then risk avoidance, like what methods you can employ. So there are various methods which can be employed, like you can have credit default swaps. You can do a due diligence, which is basically assessing the credit worthiness of borrower. Then some diversified lending, like spreading loans across multiple borrowers to minimize risk. Then we have credit default swaps, which is basically like insurance like contracts to protect against defaults. Fine. Then you can basically do diversification also, which is like investing in multiple countries to reduce exposure. Okay, just give me a second. Okay, so we were discussing the mitigation techniques. We have a lot of instruments which should be taken to mitigate the risks to basically avoid the financial funding risk. Then there is this risk transfer. Now, risk transfer is like when you are taking, you can say, when you are taking insurance to cover up that risk. Okay, so you're transferring risk to another organization from which is basically a transfer of financial risk from one party to another using some contractual arrangements like insurance based risk transfer, which is your political risk insurance, credit insurance, then your financial instruments like derivatives, swaps, options. Okay, then contractual agreements like outsourcing guarantees, joint ventures. So we have a lot of risk transfer methods through which you can cover up your risk. Then we have certain like forward contracts which lock in your future exchange rates with banks. We have currency swaps which can be used to transfer your risk. So we have hedgings with options. So these are basically your ways to transfer the risk. Fine. Then we have risk monitoring and review. Now, risk monitoring and review is like just carefully after applying all the first three methods. Okay. Then you will be monitor that how much of your risk is covered and how will you basically how will you review it. Review it basically you have to see that are those methods working for you or not. If not, then you have to redefine your step number two and three. You have to see other methods of avoiding the risk and other methods of transferring the risk. Okay, so that's a cyclical process: risk identification, assessment, then measuring, making measures for risk avoiding and risk transfer. Then in the fourth step you will again monitor the risk and review it. Okay, so that is your mitigation techniques. Fine. Then the next is your international capital budgeting. Now that's another topic in itself. So capital budgeting. So capital budgeting, first of all, let's understand what is your capital budgeting. Now let's break down this term first of all. Okay. Capital, it is capital budgeting, it is formed out of two words, capital and budgeting. Capital is like your long-term investment projects, more than 5 years, more than 3 years, huge long-term projects. Okay, they're capital. Budget is like you are deciding that okay, this much amount has to be spent. Okay, now you will, whenever we are doing a business or when we are raising funds, we have multiple options. Now, deciding which option is the best for us, that requires a lot of analysis, carefully done analysis. So, that is done under your capital budgeting. Now, because we are studying international finance, so now we are going to do this in context of your international finance only. Okay, so what is, first of all, let's understand what is your capital budgeting. Okay, now please mark this question as important because this is really important from your examinations perspective. So, capital budgeting, it is the process of evaluating and selecting long-term investment projects such as foreign subsidiaries, acquisitions, and infrastructure projects. So, in international finance, this capital budgeting it becomes more complex due to you can say currency fluctuations, political risks, all the tax differences, and cost of capital considerations. Okay, so that is your, because of your capital budgeting, because of all these risks, this entire capital budgeting also becomes little bit tricky for the organization. So how will you decide like whether to take a particular project or not? So we'll be seeing investments in, like, what are the key decisions which we need to take in the sector of capital budgeting, in whether to invest in foreign markets or not, whether to do expansion or whether to just acquire. Okay, then project risk assessment, estimating the cash flows in multiple currencies, then various cost of capital and financing options. So these are basically your capital budgeting. So when we are studying capital budgeting, there are few methods. Now I think today we don't have enough time to study the practical part. So in the next session, what we can do, in your syllabus, there was one more chapter where it had practical questions. So next session, we will be having, that is your parity conditions. That was a chapter. In that also, we have left out the practical part. Okay. So in the next session, what we can do is it will be totally for practical. This chapter's practical questions and that parity conditions practical questions will be clubbed in one session in the next week. Today, we are going to complete the theory part of the capital budgeting, and the practical part. In capital budgeting, you will be having those questions like selecting which project, project A or project B, and there will be a list of things you have to analyze. Okay, so capital budgeting and parity conditions practical questions will be summed up in one class. Okay. Today we are going to focus on the theory part because we have theory left. Okay. Just a second. Okay. So international capital budgeting, it plays a very important role in guiding investment decisions for multinational corporations operating in diverse geographic regions and markets. So it involves assessing and evaluating your potential investment projects to determine their financial viability, profitability, and alignment with strategic objectives. So we can say that international capital budgeting, it we have to carefully analyze all the parts of it. Okay, so just because you can say that because these in capital projects, they involve a lot of fund. Okay, they are not very low cost or something like that. They involve huge funds, so we have to carefully decide on each of the aspect of it. So capital budgeting, it plays important role in international finance because it helps the companies, these multinational companies and investors, to make, you can say, certain informed decisions regarding your long-term investments in foreign markets. And we can say that it is given the complexities of, you can say, exchange rate fluctuations, these political risks, and differing economic conditions, because every country has a different economic condition. So that is why we have to be very mindful about uh, choosing any project. So we have to use all the tools which are given in this capital budgeting, like identifying your cost of capital, weighted average cost of capital, debt, and payback period, your average rate of return. So all of these are the tools which are there in the capital budgeting part. Okay, we have to use those tools to identify which project is the best one. Okay, so capital budgeting, if we see if we see the significance of international capital budgeting, it lies in its ability to allocate your resources effectively. So what does it mean by allocating resources effectively? Capital budgeting, it helps businesses to allocate financial resources to high return projects, avoiding wastage and improving efficiency. So, for example, a US company expanding into India, it must decide whether to build a new factory or acquire an existing one. So capital budgeting methods like net present value or IRR, they will help in determining that which option is the more profitable option. Okay, so ensure optimal allocation of resources. Then facilitating long-term strategic planning. So capital budgeting, it aligns investment decisions with a company's long-term growth and expansion strategy. Okay, so for example, Tesla's investment in certain factories in Germany and China. It was backed up by detailed capital budgeting analysis to ensure your global market expansion. Then it helps in managing your foreign exchange risks. So international investments, they involve currency fluctuations, which can impact cash flows. So proper capital budgeting, it integrates exchange rate risk analysis into decision making. So a Japanese firm, for example, it was investing in Brazil. So they consider the hedging strategies while estimating the project cash flows in Brazilian real. So the thing is, when different type of countries they are um, investing into each other, they need to see all the parameters of capital budgeting. Like you should calculate your net present value, your payback period, your average rate of return. All of these things, they should be very carefully analyzed by all tools of the capital budgeting, and then the decisions should be made. Okay, so capital budgeting, it also helps in reducing the political and economic risk. How? Because before making your investment decisions, you see the political stability, you see the tax policies, regulatory factors. So all of these things are analyzed carefully so as to reduce the political and economic risk. So, for example, if an oil company, they are investing in Middle East, they will evaluate the government policies, tax rates, and any sort of laws which are there before investing funds in that country. So there are various things. Then the support strategic planning basically means that you are basically including the all the scenario planning, risk assessment to make informed financial decisions. Okay, so you should have a 360-degree analysis before making investments, and capital budgeting tools definitely they help you in doing that analysis. So to basically to sum up, we can say that yes, capital budgeting, it is very essential for global business, as it you can say ensures that that all the international investments, they are profitable, they're strategically sound, and they're risk managed. That we have seen all the risks parameters, we have catered to all the risks, and we have made appropriate risk mitigation strategies. So capital budgeting, it gives you all of that insight into that project. Okay, so that is your international capital budgeting. Now, factors on which your this international budgeting is based. So, first of all, the biggest factors is your cash flow. Now, basically, if we see the capital budgeting in reference to your international finance, not with domestic one. Okay, so they are very complex in comparison to domestic investments, because in domestic you have only the your country's issues you are handling, but when you are having this capital budgeting in international level, then you have a lot of things, like you have economic issues, financial issues, political uncertainties across different countries. So exchange rate fluctuations, like when foreign investments, they involve, you can say, transactions in multiple currencies. It makes exchange rate movement a very crucial factor. So currency depreciation can definitely it reduce profits, while appreciation it can increase the returns. Okay, so a US company investing in a manufacturing plant in India, it needs to evaluate your Indian rupee and USD exchange rate trends to estimate future cash flows accurately.
Okay, then using your hedging strategies, forward contracts, currency options to reduce your exchange rate risk. Okay, then we have political and regulatory risk. So changes in, you can say, government policies, taxation, trade restrictions, and foreign investment laws. It can impact capital budgeting decisions. Okay, so a multinational considering investment in Russia must assess the impact of sanctions and foreign ownership restrictions before committing funds. Okay, so there are various ways like you can use certain political risk insurance and structure investments through stable jurisdictions. Okay, then we have like inflation and interest rates. So high inflation, it reduces the purchasing power and it affects the real value of future cash flows. So rising interest rates, it increase the cost of financing international projects. So for example, a company who is expanding in Argentina, a high inflation economy, must adjust discount rates to reflect the inflation risks. Okay. Then mitigation, like use inflation adjusted discount rates and hedge against rising interest rates using your interest rate swaps. So cash flows, discount rates, all of this, they are, you can say, they are the factors on the basis of which your international capital budgeting are made. Now, if there is this cost of capital, so companies must evaluate the, you can say, the cost of capital and your this must evaluate the cost of borrowing and equity financing in different countries. So the availability of, you can say, foreign capital, tax incentives, and government subsidies, they also influence your investment decisions. Okay, then any sort of taxation system which is there in that country, that also impacts law, because different countries, they have different type of corporate tax rates. Okay, it can be withholding taxes. Some countries are having different taxation systems also. So for example, if a UK company, it invests in China, they must consider restrictions on profit repatriation and any double taxation agreements. So how you can mitigate it? You can basically use tax efficient structures. You can use certain transfer pricing strategies to avoid the double taxation. Okay. Now, next can be your, you can say, risk and risk analysis also, risk profiles. So we can say that capital budgeting, it involves a lot of uncertainty, making the, you can say, uh, risk assessment techniques like sensitivity analysis, scenario planning, any sort of simulations which you do to analyze like what can be the outcome of a particular capital budgeting decision. So if there is any energy firm which is investing in any like in India, so they will model certain different scenarios of oil price fluctuations to estimate a project profitability. So they will just try to simulate the entire condition for some probably 5 or 10 years, and then they will say whether it is a profitable project or not. So risk and sensitivity analysis is done. So you use diversified investment strategies and risk assessment tools. Okay. So international capital budgeting, it requires a very comprehensive comprehensive analysis of financial, economic, and political factors. Now, companies must incorporate, you can say, exchange rate risks, inflation, interest rates, taxation, market conditions to enter into their decision making process. Now, by using hedging and financial structuring and risk management techniques, firms can optimize their investment strategies and maximize return in global market. Okay. Now, cost. Next topic is yours. I think we have few topics left. Cost of capital of a foreign investment. Now, cost of capital of a foreign investment, it is like, first of all, what is cost of capital? Like I've explained you earlier, cost of capital, it is a combination of your
equity cost and debt cost. So cost of capital, kind of it is a minimum return a company must earn on its investments to maintain market value and attract investors. So in international finance, determining the cost of capital is very complex due to currency risks, inflation differences, country-specific risks, and global financing option. Now, why is that important? So it helps the companies to decide whether an international project is financially viable or not. So it impacts the decisions on your debt versus equity financing in foreign market. And it affects the choice of capital structure and investment risk assessment. So there are various components of cost of capital, like it is primarily determined by a firm's weighted average cost of capital, which includes both debt and equity financing. Okay, then we have cost of equity, which is return required by investors to hold a company's stock. Then cost of debt, which is basically interest paid on borrowed funds. So when both these are combined, your cost of equity and cost of debt, you get a cost of capital. Okay, so as you can see in the slide, it is written that the cost of capital for a foreign investment, it refers to the total cost of funds used by a company to finance its overseas operations and investments. So this cost of capital is crucial because it determines the hurdle rate that the investment must exceed to be deemed profitable. So it varies significantly depending on the economic environment, then currency risk, political instability, and market conditions of the country in which the investment is made. Okay, so there are various factors which impact your cost of capital, like your inflation, your country risk, your political risk, your you can say the regulations of that country. All of them, they impact the country's cost of capital. Now the next thing is your weighted average cost of capital. So weighted average cost of capital, you can say it is like the average rate of return required by investors and lenders to finance a company's operations and investments. So in international finance, this weighted average cost of capital, it becomes more complex due to exchange rate risks, country specific risks, and variations in capital markets. Okay, now why studying this weighted average cost of capital is important for your this international financing decisions, because this weighted average WACC, it helps in determining the minimum return which is required for international projects, and then it helps in deciding your optimal capital structure. It affects investment decisions in foreign markets. So we have to consider all of this weighted average cost of capital while we are taking care of the international financing decisions. Okay, so WACC is also impacted by various factors like exchange rate risk, your political risk, and your country risk, inflation, any capital market conditions. Okay, so this your weighted average cost of capital, it represents the average rate of return that a company is expected to pay to its security holders to finance its assets. Now, WACC is widely used in finance to evaluate investment decisions and to determine the cost of financing the company's operations. So it reflects the cost of capital from all sources, including equity and debt, weighted according to their respective usage in the company's capital structure. Okay. Then cost of, what are the components of your weighted average cost of capital? That cost of equity and cost of debt. So cost of equity is usually referred to as RE, and cost of debt is usually referred as RD, return on equity and return on debt. So this is the cost of equity is basically the return that investors expect on their investments in the company's equity. So the cost of equity, it can be calculated using models such as the CAPM model, which is capital asset pricing model, which considers the risk-free rate. Now, the equity beta, and the market risk premium, which is this. Okay, this formula. No, don't worry. We are going to solve questions based on this equation in the next session. Then we have cost of debt. So cost of debt, it is the effective rate that the company has to pay on its current debt. So it is often calculated as the yield to maturity on existing debt or based on the interest rates applicable to new debt. So the interest expense on on debt is tax deductible. So the cost of debt is adjusted for taxes to get the after tax cost of debt. Okay. Now, okay. Now I think the CAPM model is something which you have not heard earlier. So let's discuss that. So CAPM model is again a very, very popular method of measuring your cost of capital. So CAPM model, you can say it is kind of a technique. Okay, the CAPM model is like a technique which will help you in determining the expected rate on an investment based on its risk level. So it is widely applied in, you can say, international finance to assess your cost of equity for multinational corporations. And why it is important, like it helps in estimating your required return for foreign investments. It helps in assessing your international capital budgeting decisions and any sort of systematic risk which is there in the global market. Okay, so if we talk about CAPM in reference to your international finance, then again your exchange rate risk. So investing in foreign market, because it exposes the firms to currency fluctuations, it will definitely impact the CAPM. So for example, if there is a US investor in India and he may face INR depreciation, reducing the actual return despite a high CAPM return. So these things will not be able to easily understood by you until unless we solve some questions. So in the next session, we are going to solve some questions on the CAPM and this cost of equity. So it will be easier for you to understand this concept. So with this, today's all the discussion part is done. We'll quickly run through the slides and see what we have done. So we have understood the importance of international financing decisions. So, and what are the factors which influence? So these are the factors like the market conditions, regulatory environment, risk considerations, cost of capital, your strategic objectives, investor preferences, exchange rate considerations. These are basically the factors which influence the financing choices. Then there are certain issues in overfunding, overseas funding choices like we have FDI, international capital market, multilateral institutions, foreign banks, and financial institutions. Then there are a lot of advantages to it, like we get an access to a larger capital pool. Then we have this diversification of funding resources, then lower cost of capital. So these are basically the advantages. Then we have certain set of disadvantages, like we have currency risk, regulatory complexity, political and country risks. Okay. Then factors influencing overseas funding choices. So when evaluating your overseas funding choices, multinational corporations, they need to consider various factors like interest rates, currency risks, regulations, etc. Okay, then there are several key economic factors which may impact funding decisions, like we have interest rates, inflation rates, growth prospects, currency exchange rates. Then what is the role of macroeconomic indicators? So we have GDP, inflation rate, unemployment rate, interest rate, and consumer confidence, because of which your these macroeconomic indicators, your international finances also, international bor funding is impacted. Fine, then these are certain risk management aspects like your diversification, hedging, insurance, and your scenario analysis. Okay, then there are a lot of mitigation techniques like risk identification and assessment, then risk avoidance. After that, we go for risk transfer, and then finally risk monitoring and review. Now, if in review part you find that something is not working out, you go back to the first, and then again the cycle continues. Okay. Then international capital budgeting. What is basically capital budgeting? Planning for bigger and you can say
high valued investments. Okay, so deciding on whether to take up a particular international project or not, you will be using the techniques mentioned under this particular topic of capital budgeting. Okay, then your cost of capital and WACC. This we have already discussed. So that's all for today's session. I hope you were able to understand all the topics. This is slightly, few topics are slightly trickier, like CAPM model and everything. So in the next session, we are going to have this practical questions of two chapters. Okay, this chapter and the parity conditions. So, if you have any queries, please let us know. Okay, we'll be more than happy to cater to your queries. And thank you so much. That's all for today. We're going to meet in the next session. Thank you so much.